Good morning, everybody. Thank you so much for joining OTC Markets and DA Davidson as we discuss trading on OTC Markets. I'm Laura Hamilton, Vice President of Corporate Services at OTC Markets in New York City. Today, we're here to discuss the markets available to trade on OTC Markets, if your bank should consider going public, and how corporate brokers such as DA Davidson create liquidity in community bank stocks. Before we get started, I'd like to address a few housekeeping items. All attendees are on mute and will remain on mute throughout the presentation. All Q&A will be addressed at the end of the presentation. Please enter questions into the box on the right-hand side of your computer screen. Additionally, all contact information is at the end of the presentation. Joining me today are Michael Natzik and Tom Dooley, both with DA Davidson. So to get started today, you might be wondering who OTC Markets is. We are a publicly traded company on the OTCQX market, and our ticker symbol is OTCM. So we've actually been around for over 100 years, and we operate the trading platform for three markets: the OTCQX Best Market, the OTCQB Venture Market, and the Pink Market. 10,000 domestic and international companies trade on our market, including BNP Paribas, Heineken, and Adidas. So we really launched the Pink Sheets back in the early 1900s, and then in the late 90s, OTC Markets purchased this to make it electronic. In 2007, we launched the OTCQX market. And then in 2010, we launched the OTCQB Venture Market I mentioned, which essentially replaced the OTC bulletin board, which used to be owned and operated by FINRA. It's virtually non-existent in today's environment. So back in 2014, we launched the QX Banks market with 10 founding banks. This was as a result of the Jobs Act of 2012, when the number of shareholders changed for banks to be SEC registered or not. Then in 2015, we created an OTCQX Banks Index. Fast forward to 2019, and we now have over 130 banks that have joined OTCQX in 5 short years. We also opened a London office, and we made 2 acquisitions in the past 6 months: a virtual investor conference, which we acquired from PR Newswire, and QARAVAN, which is a data provider and a CECL solution that I'll get to later. At this time, I'd like to introduce Michael Natzik and Tom Dooley to go over DA Davidson and the trading options available for your bank.
Well, good morning, Laura, and thank you. Again, my name is Michael Natzik. I'm with DA Davidson, and here with me today also is my colleague, Tom Dooley. We're part of the Community Bank and Wealth Management Group here at DA Davidson. We live and breathe community banks. Currently, DA Davidson makes markets in several hundred banks across the country, and we look at continuing to add to that list. Making markets in community banks is very much a specialty niche, and there's only a small handful of entities that do that in the country. The unique thing with DA Davidson is that we have the Community Bank and Wealth Management Group. As you can see from this slide, we're a group within the company that specializes in community banks. Primarily anything sub-NASDAQ is our specialty, although we do work with NASDAQ banks as well. We are the leaders when it comes to anything on the OTC market. The other thing that's unique about DA Davidson is that we're uniquely designed to support community banks. If you look at the firms out there that work with community banks, we are the only entity out there that covers every touch point of a bank's needs, whether that is the bank's specific needs, shareholder needs, portfolio needs, investment banking, you name it, we cover it. And so it puts us in a really unique position. And the Community Bank Group continues to grow within Davidson, and it's a very exciting piece for us. A little bit about DA Davidson as a whole. We can move to the next slide there, Laura. DA Davidson is regional in nature. We have about 92 offices throughout the United States. We couldn't be further off Wall Street with our headquarters. We're based in Great Falls, Montana, with regional offices in Denver, Los Angeles, Portland, and Seattle. We're founded in 1935, and then about 3 or 4 years ago merged with Kroll Weeden, which is where our group came from, and gives us a national presence across the country. I'm out here in the West. Tom and his team are out in the East, and we look to continue to expand our footprint. Basically, wherever we have relationships with banks, we're looking at growing that footprint over time. And I'll go ahead and hand it over to Tom.
Thanks, Michael. Actually, I'm in Columbus, Ohio. I'm in the Midwest, so that's at any rate. I'm going to go over just some, what is the over-the-counter market? Because over the years, it's kind of changed. When I first got in the business, it was, NYSE and Amex and everything else was over the counter, whether it was NASDAQ or bulletin board or the pink sheets or the gray market. Today, it's just kind of morphed, into everything that's everything that's not on NASDAQ or the Amex or New York Stock Exchange. The gray market, basically, those are banks that the trades are reported only. They just have a symbol, so they're not really traded on any type of platform. But so the 3 different components of the OTC markets platform are QX, QB, and pink sheet banks. You can go to the next slide, Laura. You can go to the next slide. There we go. All right. And the other thing, before I get into the benefits of a public market, I kind of want to address this public-private, and it comes up all the time. So it seems, at least for banks anyway, the general consensus is if you're not SEC reporting, people call themselves private. So we can live with that, but we're going to talk about a public market. And so, for us, that means someone, who may or may not be SEC reporting. I'd say the majority, a lot of the banks traded OTC are probably not SEC registered. I've never counted them, but I would assume the majority are indeed not SEC registered. So, we kind of think you're public because you trade in a public market. But at any rate, so the benefits of public market, visibility, obviously, your shareholders, both existing and prospective shareholders, can benefit if your stock looks like anyone else's. They can pull up financial information, trading information that, that is certainly helpful, that you look like other institutions. Laura touched on the SEC and the Jobs Act, but because you're a bank, there's a simplified trading process. Less than 200 shareholders, generally speaking, you can trade on the QX and not have to worry about SEC reporting. One of the other benefits is liquidity, and liquidity and volume are not the same thing. And a lot of boards confuse them. We talk to a lot of boards, and they want volume, and the typical community bank is never going to have a whole lot of volume. Particularly, here in the Midwest, if you look at a typical bank, say a $400 million bank, that's owned by people within the community. The shares are generally certificated. There's not a lot of float to begin with, and so they're never going to have big volume, but they can be liquid. The day that a seller shows up, are there sufficient number of buyers to get that trade done? And we'll get into that a little bit later, but that's important not to confuse the two. I would say that a lot of the banks that trade over the counter are very liquid. Some more liquid than maybe some of the NASDAQ names that are on the small side of that market. And then the other benefit is evaluation that's away from the bank. It provides a currency for the bank. It provides an arm's length price, and it's you get a last trade. I mean, it couldn't be more simple than that. So if you're considering or you are already traded, there are some things that you should understand. And Michael, I'll let you get into the next slide.
Actually, I think this one Laura was going to take.
Thanks, Tom. So some of you may be wondering, some of you are probably already on Pink and already have a ticker symbol out there. Some of you might not have any ticker symbol and be completely private. Some of you might be on OTCQB, the venture market right now, and some of you might be on NASDAQ. Those are essentially the 4 different buckets you could be in for being a bank right now. So for those of you that are private and or looking to essentially uplist or delist your stock, it's kind of like, what is the process? So the first thing to do is consult your market maker of choice, your QX corporate broker. So this is somebody like D.A. Davidson. And you need to determine which venue is right for you and for your bank stock. Obviously, we've gone through some of the benefits, and we'll get more into this as we continue. If you're private, you need to have what's called a Form 15C-211 filed with FINRA, the regulator, to establish a trading symbol. Tom and Michael will go into this more, but this can be done without your really checking the box and approval, which is a little scary, and they'll touch on that in a couple of slides. So after this is really determined, this form is filed, you simultaneously submit an OTCQX application with us. You're then going through and selecting a transfer agent, as a transfer agent is required to trade on our upper tiers of our market, and it takes away a lot of the risk of trading over the desk. You then verify your QSIP number and get DTC eligibility, and you apply for either one if you need to. DTC is so that shares can clear electronically once there's a market for the bank stock. You'll go over your blue sky status and see what you need. We'll also get into that a little bit later. And then hopefully with about 8 weeks later, 6 to 8 weeks is the average timeline, the 211 form clears with FINRA, and then you begin trading on OTC markets. At this point, I'm going to turn it over to Michael to really go over how market makers work with us and things to consider.
Thank you, Laura. You know, when you look at your markets, and if you're going to create a public market or become more shareholder or market centric, you know, this is where Tom and our teams can really be helpful to you. You know, when we go back on that previous slide that Laura just went through, you know, most of those items, those are things that we can help you work through, or we can do for you. But you know, one of the things that you want to do is really take into account the things that to consider as you look at your markets, where you want to trade, and what do you want to look like. You know, some banks out there may only want that small shareholder base. They may not be looking for the liquidity and so on, but you may have, for you may have been that way for the past 10 or 15 years, and now it's time to really become front facing in the market. And this is where we work with a lot of boards and management teams, and really looking at the considerations of the pieces that you need to look at as an issuer. You know, can you clearly define your story, where you want to be, what you want to look like, and what is that front-facing image? You know, how do you want to look to your shareholder base in the investing world? One of the things in the past is when we were to look at the prior markets that were around, when we go back to the OTCBB, is that, you know, there wasn't a lot of visibility out there. And through the markets today, the avenues that we have, and we look at the technology that's out there, you really need to look at that front-facing image. That becomes important to not only your current investors, but to prospective investors. And then looking forward, how do your markets need to be scalable? As you grow, as your bank grows, as your market grows, can you continue to scale with that? And that's an important piece of going forward is, you know, how much can your market grow with you, and how much are you willing to pay as part of that? One of the things here in the past that was a big change for a lot of bankers is that for the most part, if we rewind 10, 15 years, there wasn't any cost to pay for the markets. You were on Pinks, it was very simple, or you were on the bullion board, very simple. There wasn't a cost, and that cost of those markets was primarily borne by the industry. What's changed here is now we have better tools for you, better front-facing tools, better markets for you, and there is a cost that comes with that. Does that come out of your general budget, your marketing budget, and where does that come from? But I think it's one of those pieces too to become more shareholder-centric out there. And then depending on how you grow, is SEC reporting a piece to that? One of the things that I like with OTC markets is that you don't have to take on that SEC reporting piece. That's a big piece. And if you're looking at going on NASDAQ, or if you're on NASDAQ currently, in looking at your cost structure, that SEC reporting piece for most banks can be upwards of $500,000 a year when you base in all the pieces of your markets in your additional personnel and your reporting. Currently on the OTC markets, none of the three markets requires that, which is a nice benefit because you're basically as a bank, you already report to everybody under the sun, so it's just basically continuing what you're already doing. Looking at the volatility, we want to consider that. You know, what kind of volatility you're going to see on your markets, and then, excuse me, going back to what do you want to look like over time. And then one of the big pieces is looking at your ideal investor. You know, when a bank capitalizes, as you all know, you know, most of the times your initial capitalization comes from your community and from your clients and your and your friends and family that are close to the bank. Do you want to keep that, or do you want to look to more of an institutional base? I'm a firm believer that every client should be a shareholder and every shareholder should be a client. And I think that brings a very loyal shareholder base. Institutions are important to have in there at times, but you really need to think through what do you want that shareholder base to look like, and then how do you create that over time. Tom, was there anything I missed in there that you wanted to add?
Well, the ideal investor, I just think is so important because I'll give you an example. There's a bank that we deal with, and it's in a rural market, and you know, we talked about their ideal investor. They want individuals. They want local people. They don't want you know, they'd rather not have anybody, you know, outside of their market, and they really don't want any institutions or other banks buying their stock. And that's great. We hear that all the time. But they're traded on the pinks. They are not blue skied for secondary trading in their own state, and they didn't want to, you know, do anything to rectify that. And so, without getting into all the rules, basically, the only people who could buy their stock were institutions and other banks and you know, accredited investors. But the market, you know, the shareholder they didn't want, they opened themselves up to you know, to be available only to that type of shareholder. So if you're not familiar with blue sky laws, basically a brokerage firm cannot solicit a purchase order in your stock if you're not blue skied in the state where the customer resides. And so then the brokerage industry is even taking that a little bit further, and a lot of firms just won't deal with the stock at all if it's not blue skied in you know, in a large number of states. And so make sure your ideal investor. It's great to have an ideal investor. It's probably number one. Make sure that you're doing the appropriate things so that that ideal investor can actually be an investor. So that was that's it from my standpoint.
Thanks, Tom. And then why don't you comment about understanding FINRA and back to some of that 211 form targeted towards some of the private banks that might be on the call that we touched upon?
So it's kind of a funny slide, understanding FINRA, but so they're the primary regulator in the securities industry, and because we're trading your securities, they've kind of inserted themselves into you know, into your world. So Laura touched on this FINRA Form 211, which is basically what's filed so that your stock can trade on one of these venues. But what the form itself is I believe it's 7 pages. And I think you probably need to have a 6th or 7th grade education to fill this out. It's not a, it's not a complicated form. And the information that goes in the form is summary financial information, information about the board. Almost every piece of information is publicly available. And so a large number of banks that are traded now over the counter are what I call accidentally public. A broker without your knowledge filed a Form 211 at some point in the past, and boom, your bank was publicly traded. And there's not even a notice that would allow you, to recognize that this has taken place until you hear from FINRA. So FINRA requires corporate action notices for any bank who is, publicly traded, and they fine you if you don't send them in. They're looking to make sure, they want to know when you pay a dividend, they want to know if there's a stock split so they can adjust prices and protect the public. But as I mentioned, there are banks out there, the first time they realize that they're publicly traded is when they get this notice from a new regulator. So, for those of you guys who are still private or not traded on a public market, I would, certainly, keep an ear out and try to be aware. And for some of you who may be accidentally public, I would, suggest that you not ignore it, because it won't go away. Even though we're on the brokerage side of the business and we file a 211, it is amazing to me that this is how it works. It's a little different on the QX or the QB because there's a corporate broker involved, but basically that's how FINRA has inserted themselves into your business. And I'll go on to the next slide. Some of these are common terms.
Can I touch on something real quick?
Please.
I just wanted to mention back on the Form 211 process is if you're currently not publicly traded, I think it's important to drive that process, because as Tom indicated, is that you don't need the permission of the issuer to file a Form 211. We as a group don't believe in that. We look at us as your partner, and we want to work with you as the issuer. But the reality is that there's other broker dealers out there that don't believe in that, and they will file, if they've got a trade pending or some demand to either buyers or sellers. So if you're even considering it, creating a public market, I would very much encourage you to drive that process rather than letting somebody else drive it for you. So, thank you, Tom.
That's a good point. All right, so a market maker. It seems obvious, but the function of market maker comes up a lot, and there is some confusion. Right? People understand that the broker dealer that posts a bid or offer for your securities. But much like the 211, the bank really has no input or control over that. So if someone files a 211 for your stock, the first month there's one market maker. After 30 days, more and more can join, and after a year you might have 10 market makers. You might have a relationship with 2 or 3 or 1 or none. But it's important to know, who these market makers are. Different market makers really perform different functions. Some of them, capture order flow from larger brokerage firms. They may or may not even realize that you're a bank. And so some of them are electronic trading networks. I've seen banks list these electronic trading networks as a market maker and put a phone number. There's nobody there to take that call. So you should familiarize yourself with with all of your market makers, but understand the differences between them. The corporate broker we've mentioned a few times, but basically it's a qualified market maker that can help you through the QX process. DTC, I've been in this business a long time. I still couldn't tell you exactly what they do. I own several community bank stocks, a lot of them. I probably don't get my paperwork on half, of the bank. So it's kind of a big black hole, but there's certainly a necessary. They provide a necessary function. And if your stock is not DTC eligible, but it's not available to be traded electronically, it can create some problems for your shareholders and the market maker. Transfer agent, we talked a little bit about that. I mean, it's obvious what they do. I will tell you this, for most of the banks, most of the times where we've talked to a bank and they think that they want to be publicly traded, and we talk about a transfer agent, that's where things seem to go south. And I know that at a lot of these banks, there's a person who really is in charge of transferring the shares, and they like that they talk to all the shareholders, but it really is a job better performed by someone else, particularly in light of the fact that DTC is now charging $500, and they have been for a while, for a stock certificate. And so if we find a buyer in your town, and lucky enough that they buy some stock, and now they want a certificate, you don't have a transfer agent, DTC charges us $500. So we have to charge the client $500. With the transfer agent, there are a few workarounds for that. So I would, if you're not currently using one, I would certainly look into it. And the QSIP Bureau, I mean, we touched on that a little bit. I will tell you, most of the banks, particularly bank holding companies we've run into, already have a QSIP. They don't recall how they applied for it, probably when the holding company was formed. So you need one, and you may already have one. So that's basically how the QSIP works. All right.
Thanks, Tom, for that. So I'm going to go to the next slide, and we keep mentioning QX and QX for banks. So you might be saying, what is it, and what is some of the additional benefit? What's the peer group really look like? So right now we have 90 banks currently traded on QX, and you may be saying, is my bank too small? Am I too big? QX versus NASDAQ, really, what's the difference? So no, you are not too small, you are not too big, you can trade here. We are a broker-driven market instead of an electronic matching engine. So for bank stocks that have, let's call it a couple million shares outstanding, or even less on average, it actually is a benefit, and we'll get into this in a slide or two, about having brokers trade your stock. So we do an OTCQX top 50. As I mentioned, we have a plethora of international and domestic companies that are non-banks. This year, 32% of our top 50 companies were banks. So that's great exposure for them. We brought on 27 new banks last year. That was triple the number that joined in 2017. And a number of them have been private to public transactions. It's much less expensive than listing on NASDAQ because of the non-SEC registration fees, the legal fees, the investment banking fees. It's a pretty simple process, as you could see when we went through the process of going public, essentially. And then for those of you that are on NASDAQ, we've actually had 10 banks leave NASDAQ or NYSE since we started the market, and a number of them are trading up in price and increased volume pretty quickly after joining because, again, of the broker-driven market. And they've been able to increase their dividends for their shareholders as a result of the lower listing fees and SEC registration fees. However, that does not mean you have to deregister with the SEC, but it's very much a choice the bank and the bank's management team can make. We also have the OTCQX Banks Index. It's up 95% since we started it in 2015. And those banks that have uplisted essentially to QX have really seen a 62% increase in valuation once trading there. So going on to the next slide, just wondering who is even joining QX. And again, separating it by different buckets, let's call it. So the private banks, 20 have gone public on QX since 2014. About 7 of those were last year, and I expect that momentum to continue. It's a great way to get liquidity for your shareholders at a fraction of the cost of the IPO. To go into fees, because we keep mentioning those, our fee is only $20,000 annually and a one-time $5,000 application fee. This is all prorated for your first year based on January 1st. to trade on NASDAQ, you're going to look at a $75,000 initiation fee and probably about $45.50 as an annual listing fee just to start. It really depends on the size of your bank. You could be 100 million in assets or 1.5 billion in assets, and it could be a flat fee on our side. For those of you on Pink or OTCQB looking to join QX, we've had 20 banks uplist since last year, and we just did a study of those looking at the first 3 months of trading on QX since uplisting primarily from Pink. Price growth just over 3%. Market cap growth is close to 6% in your first 3 months, which is pretty strong. And then your average daily dollar volume growth is up almost 11%. So it really is all of these pieces to make QX a more compliant, transparent, and efficient market for a very low price, frankly, to see these kinds of numbers. And then for those of you that are on NASDAQ or NYSE, again, we've had a number of banks delist, and it's a cost savings. And again, if you're under 1,200 shareholders of record, you're eligible to deregister from the SEC. Then Tom is going to chime in on this slide with me, but SVBT is a bank that went public on QX last year. They joined in 2018, and they've done extremely well. This is a bank that was $350 million in assets when they joined. Today they're about 400. They opened up at about $67, and today they're right at 80. Market cap has increased $7 million in just a few months. And what's really unique about this bank is that they have less than 500,000 shares outstanding. Something I like to tell private banks is when looking at trading your stock is the question is how much volume am I going to get? How many shares a day? And what I tell them is you're never going to trade like Apple or Google, and that's because you look at the total shares outstanding, you just can't support that. But, and Tom can get into more of the trading aspect here, but this is a bank that's done extremely well with having less than 500,000 shares outstanding. And Tom, I'll turn it over to you at this point.
Well, thanks. So yeah, it was interesting because their initial trade was $67, and I think locally, you know, prior to the listing, it was trading for less than that. You know, so in my experience, when you have, you know, pent up sellers, you know, there's not a lot of demand, you've got a lot of sellers. Approximately when these people feel they can't sell their shares, of course, that's when they really want to sell them. And once people find there's some liquidity, in our experience, about half of those people seem to go away. You know, once they find out they can sell them, they're very comfortable to hang on. At any rate, the stock has moved up nicely, but back to the volume. Over the past 100 days, the average daily volume in the stock is 520 shares, which is, you know, not remarkable. There's a lot of days that it's zero. But the other day, the stock traded 14,000 shares, and the stock didn't move. And then a few months back, we had another 17,000 share day without any real price movement. You know, caused by the you know, the large volume, and that volume is probably just like the volume in a lot of your banks. It's a function of circumstance. It's somebody passed, somebody had you know, some bad luck in their business or whatever. These are shares that need to go into the market. They go into the market in a hurry, but you know, they went into the market successfully and didn't you know, didn't affect the price adversely. And then the other thing that I thought was interesting, if you look at the KBW NASDAQ Bank Index, which is a different index, but nevertheless, this bank has the price has outperformed the KBW NASDAQ Bank Index by about 20% since it started trading on you know, on the QX. Now, a lot of that is the inefficient market that it came from, and you know, there's some price discovery as things went on, but as you know, as I mentioned, once people find there's liquidity, some of the sellers seem to go away. So, and then Michael is going to explain a little bit how that works on the next slide.
Thank you, Tom. We are throwing just a mountain of information at you guys here this morning. I appreciate you hanging in there, and we're going to open up for some questions here in just a little bit. But wanted to talk a little bit about the mechanics of trading. And one of the things that's a little bit of a mystery to some issuers out there is how the trading actually works and the mechanics of those pieces. And we're always happy to talk to you one-on-one going through your markets if you're already publicly traded, or spending some time explaining how those pieces work. So what you're seeing here in this slide is this gives you just a little glimpse of a couple banks. These are actually two separate screens that you're seeing here. So the one on the left, GSBX, that's Golden State Bancorp out here in the west, and on the right is SBKK, Suncrest Bank up in Central California. On the left, you'll see that we have a GSBX is a pink issuer, so they're on OTC pink market, and you can see the difference in what you see out there in the markets. And much like an issuer or a bank has their own symbol, so do we as market participants. So over on the left there, you'll see on the left-hand side, about the middle of the page, you'll see a number of what look like symbols, and you'll see one that's in green, that's DADA, that's data, that's DA Davidson. So that's how we're identified in the markets as a market participant. And down below Davidson, you'll see other market participant IDs, and those are other broker dealers out there in the market that make a market in that stock. The way the markets work is that every market participant or market maker will put out their best bid and ask that they have in the market. And then the system then takes that and organizes it, basically, is a good way to think about it. If you look at the two columns, you have a bid column and an ask column. The bid column will sort the best bid or the highest bid, and the ask column will sort it by the best ask or the lowest ask. When you look at the bid and the ask, they may not be coming from the same market maker, they may be coming from others, but that creates the official market for the stock. Referring to the slide on the right-hand side, the QX, it works the exact same way, is that we have our quotes out there, and they will organize those accordingly and create the official market for the stock. The one thing to remember is just because a market maker may not be the high bid or the low ask on the stock doesn't necessarily mean that they don't have interest in the stock or that they don't have an order in hand. It basically means that they may be working within that official market that's been identified there. So it's important to understand that sometimes if you don't see your market maker at the top, it doesn't necessarily mean that they don't have interest. It's just that they're trading against other market participants' bid and asks out there. So it creates the fairest and market to the investor out there in the market. And one thing, important difference between the two slides is on the pink, those are going to be more of a delayed environment that you're going to see out there on the screens. Whereas on the right within OTCQX, your level 2 actually shows on the internet, and it's a real-time feed. So you can see where those markets sit at any time. And one last piece to put there is you'll see in all of on both screens, there's a size column, and it says, I think the good majority of those say 100. What that is that's the size that we as market makers have to be good for if we have a bid or an ask out there. In many cases, that's the minimum we have to be good for. So you may have a trade come through in the system. That's the size that we need to honor. We could be good for more than that, but a lot of times, don't be surprised if you only see 100 there. And the reason for that is sometimes orders will come in very quickly into the market. If somebody puts something into an electronic platform, they may have the way that comes into the market could be 100 shares at a time. And we don't know if that's a 500 share seller or a 5,000 share seller. So for us to be nimble and be able to manage that market, that's many times why we only show that size of 100. Also, we want to be careful not to be disruptive in the market by showing too much or too less. Tom, did you have anything you wanted to add on that?
I had a couple items. I'm going to go to the quote on the side, or the right side, excuse me, the SBKK. I'm going to assume on the bid side here that these sizes are actual, all right, that this is really what's going to happen. So a lot of times a banker will say, gee, my stock traded, 3,100 shares today, and it was down 70 cents. And so if you look at this, again, let's just pretend that these sizes are true. So the first 100 shares would go to FIG Partners at 1170. The next, and then he would drop. If he doesn't buy them all, he has to move, and so he would get out of the way, and then so on. So the next 100 would get executed at 1145. Then we would be out of the way, and so on. And so you can see 1, 2, 3, 4, 400 share size in the market until you get all the way down to $11, and that guy's looking for 2,500. And so basically, to get that 3,100 shares executed, that would basically, take the stock all the way down to $11 in theory, and down 70 cents. And that's basically how that works. Sometimes someone will say my stock was down 30 cents, only traded 100 shares. If we go to the GSBX on the left-hand side, let's assume DA Davidson was only good for 100. There were 200 shares in the market. 100 shares traded to 1740. Your next trade is 1710. So that's how, these things move up and down. And then the other question I get a lot, we'll stick with the GSBX, the Wedbush. If we go to the offer side, they've got a price of $1,500. He's not really trying to sell stock at $1,500. There are on some markets financial incentives, small ones, to post a two-sided market. A lot of these firms trade a lot of other NASDAQ stocks. They have internal computer systems that might populate the other side of the market and just be completely out of the way. What he's really saying is he doesn't have a seller. He's not involved in the market. And the last thing I would say is if I'll go back to this SBKK again for a second on the bid side. So the bid price is $11.70. If your shareholder comes to us, to DA Davidson or to anyone on here, and they have stock to sell, and our bid is $11.45, a customer still gets $11.70, whether we buy it or whether we sell it to the other firm posting that market. That's the price that your customer gets. So just because these market makers might be away from the best bid or whatever, doesn't mean that your customer is harmed in any way by routing their order someplace else. They will always get that price, regardless of who the brokerage firm is. So that was it for me.
Great.
Those were my 3 points there.
At this point, we'll open up to some questions. So again, you can type them into the box on the right-hand side of the screen. I'm going to keep moving forward just in the interest of time here. But if you definitely have questions about the mechanics of trading, please do type those in. And again, contact information will be at the end of this. So Michael is going to discuss Blue Sky and what this means. And just to note, OTCQX has automatic exemptions in 34 states for Blue Sky trading. And then Michael, hand it over to you.
Thank you, Laura. This is an important slide. We want to make sure we add it in today's presentation. And we're almost to the end here, guys, so we can, like I said, open up some questions, and you may have some questions on this slide specifically. Is Blue Sky status is one of those things that didn't used to be a big deal for a lot of banks over the years. I can tell you in my career, Blue Sky would come up every 2 to 3 years, and then it would die a death, and we wouldn't really talk about it again. What's happened in recent years is Blue Sky has really become a major issue within our industry. And just to kind of bake it down a little bit for you, is Blue Sky status refers to the registration of your stock in a state. This is something that we didn't have to worry about before, but it's a very key and important piece right now, and this is the resale of those securities in your state. So this really plays an important piece to your market. If you're just a bank, okay, most states will exempt you from registration. Okay, so if you don't have a holding company, you're just a bank, then you don't have to worry about too much of your Blue Sky status. Once you create a holding company, that changes. And it's because the state laws are very murky as far as how they address registration for bank holding companies. There's very few that are actually clear on this topic. And if you look at the map there that's in front of you, you'll see that if you're on OTCQX, that covers 34 states. By just being on QX, you're automatically registered in those states, whether you're a bank or a bank holding company. But what if you're not on QX, or what if you're on QX but you're in one of those states that isn't colored? This is something that you need to address. For example, California has one of the most complex corporate codes, and also a lot of breaks in their corporate codes. So there's some additional filings you need to do there. And the reason this is so important is because this affects the resaleability, and it also affects the type of investors you're going to look at. If, for example, if you're not blue skied or registered in your state, then it could affect the type of investors that are able to purchase your stock. For example, you may only be open to institutions or non-solicited transactions from accredited investors. That really narrows down the scope of who can buy your stock, and also who's supporting your stock from the market maker standpoint. A great example is you may not even be registered or blue skied in your own state where you're located. So this is an important piece for you really to consider. This is something that Tom and I can help you with. We have a database. We can look up the states that you're blue skied in so that you know what you're tackling. Another reason why this is extremely important and why this has reared its head is that one of the major wirehouses was recently fined $21 million because of blue sky violations. And this is why it's a big deal. One state picks up the issue, the other states jump on board, and before you know it, you have multiple states suing you for violations, or fining you, I'm sorry, for violations. So this is a key thing. It's a little bit of a mystery to some banks, but this is something that in recent years is really just not going away.
Thanks, Michael. Appreciate it. So then moving on to the next slide, why visibility matters for your bank. And again, I'm going to kind of move through some of these quickly, but there's only about 2-3 slides left. But a benefit of being on QX is the amount of visibility. As we mentioned earlier, the index, I mean, that's a big piece to be a part of it. And we also made an acquisition of the virtual investor conference earlier this year from PR Newswire. We hosted one for banks last month, great turnout, both retail and institutional coverage, dialing in. It's a great way if your bank isn't ready to go to the larger institutional conferences to dial in from your office, give a presentation, get comfortable with that idea, and it's kind of like this, where people will type in questions on the side, and it's a back and forth from a Q&A. So that's an exciting piece there. We mentioned the OTCQX Best 50. We have a market center here in New York City. We can do video interviews with CEOs and CFOs. We then push that out through our distribution network. We allow the bank to do that via their distribution network as well. We issue a press release on the first day of trading on OTCQX. We get local press contacts to share that story locally. And the idea then is to help drive some new customers in and get more loans and deposits for the bank. We also have our monthly newsletter, and you will get Morningstar coverage when on QX. And then just diving into QARAVAN quickly, this is our other acquisition. Essentially, it's meant to be a lower cost alternative to SNL, the data provider. We also are introducing a CECL solution this month. Again, a very cost-efficient solution compared to some of the other providers in the market. Let me know if you want a demo. I can get that set up for you if you are interested there. And then a question that did come in is, what are the reporting requirements? And it's very timely because it's a question I get a lot, and we have this slide. So a lot of banks are concerned about the reporting requirements for QX, and what if they don't meet them? What if they're not there? However, the good news is that most banks' current disclosure does already qualify for OTCQX, which makes it a very simple process. Whether you're currently publicly traded, whether you're private, we're able to use your call reports, and we have you upload those. The other piece from a reporting standpoint is we do ask for a quarterly balance sheet and income statement summary. And this is something that most banks already have in a quarterly earnings release. If not, we work with you to help draft those and upload those to our site. We do require that you have at least $1 bid price, total assets of at least $100 million, have a transfer agent, and have annual audited financials. Otherwise, most banks already have the audit committee. You have your annual shareholder meeting, and it's a pretty straightforward process there. So at this point, I'm going to turn it back over to Michael real briefly to talk about D.A. Davidson's upcoming event, and then we'll open it up for more Q&A.
Thank you, Laura. I'll just spend a few seconds here. Our upcoming event, we have the D.A. Davidson's Financial Institutions Conference, which is held in Bloomfield, Colorado, near Denver, May 6th through the 8th. This is a great conference that D.A. Davidson puts on. We have it in the middle of the country, so it's a little bit easier for everyone to get to. But this has been a growing conference, grows every year. And whether you're a larger institution or a smaller institution, I think it's a great experience for you, and we'd love to see you there. If you haven't received an invite or if you have more questions, feel free to reach out to me or Tom. We'd be happy to get you an invite, and we'd love to see you there. Again, a great conference. And even if you are a smaller bank or you don't have a public market and you just want to come and observe and kind of get a feel for that conference feel out there, we'd love to see you there. But please feel free to reach out to us for an invite, and we'll make sure you get that. Thank you, Laura.
Thanks, Michael. And then here's everybody's contact information. There are a couple of questions here about the slide presentation being available for download. We will be sending it out with a replay of the webinar for if you want to send it to any of your management team, your board of directors, from an educational standpoint. And it'll be on our website as well as D.A. Davidson's website as well. So we will be doing that. And then another question that came in, and Tom and Michael, I'll turn this one to you, is can an accidentally public bank determine who filed the Form 211 if they were a private to public transaction, essentially?
I'll go ahead and take that. Basically, they can, by contacting FINRA, they can see who actually filed that. The unfortunate thing is once it's filed, it's filed. So there's not really a way for an issuer to stop that process or interrupt that process. The one thing that you will find is that FINRA can be nitpicky. Sometimes they need that institution's help to finish the filing. But the only way, unfortunately, the way that most institutions find out is when they go live and there's a symbol out there.
Great, thank you. And then Tom and Michael, what's the typical timeline and overall time from a bank deciding that they want to uplist to OTCQX, whether they're on Pink right now or private or even delisting?
As far as the uplisting to QX, that's actually a very quick process. I have to say that OTC markets is far better to work with than FINRA in this when it comes to the filing status, because once you get through that Form 211 process, you've done the hard piece there. The uplist to OTC markets is very quick, within a couple weeks. They're great to work with. They have a team that works with you on that application. But the other piece that's important here is if we're assigned as your corporate broker, we're there as your partner to help you through that process. So we'll walk you through that. We'll work with you. We'll work directly with OTC markets on your behalf. I don't know what the average time frame is right now, Laura, what you're seeing, but it is a quick process.
From a Pink or QB upgrade to QX is typically 2 to 3 weeks for our end. And then the private side, I mean, from what we see is really kind of what you said. It really depends also on FINRA and the filings there and getting these smaller pieces like the transfer agent lined up and whatnot. But I say to a lot of banks, you can do it in 4 months if you really kind of have it together, or it can really be 6 months as a process. A blue sky question. Can you explain the limitations if your home state is not exempted from blue sky laws and how you go about getting registered?
It really depends. I'm going to add a comment, and I'm going to let Tom comment as well. It really depends on your home state. In different states have different requirements. Out here in the West, with some of the states, it's a very simple filing. It's a one-pager. You send it in. California's probably the lengthiest, but still not that bad. So it's an easy one to do, but it really just depends on what that state's requirements are if you're not already blue skied. And this is where it's important to take a look at what states you are blue. You may be blue skied in a state and you don't even know it. And that's why it's important to connect with us. Let us look in the database and give you some information on that. Tom, do you want to add some of your experiences?
It's in this part of the country because there are broader exemptions, like emergence or OTC markets. They're a better way to go because it's much cheaper than filing individually with a lot of these states. A lot of these, unfortunately, states, they themselves don't even understand what the blue sky laws are. And so, we've had several banks hire attorneys and just end up just spinning their wheels and not getting anywhere. So, I would suggest a different route. I'd look for more of a global solution.
Yeah, and I think that's an important part is a lot of the states themselves, when you call, don't understand the question you're asking. So in many cases, I think that's where it's important to connect with us. Let us help you walk through that process a little bit, just because we run into it with a lot of issuers. And so, we've walked down a lot of these roads already.
Thanks, Michael and Tom. So in the interest of time, that's going to wrap up our Q&A session today. Again, please feel free to reach out to any of us directly for any further questions, and we'll absolutely get you a response. So thanks again for joining OTC Markets and D.A. Davidson. As I mentioned, a recording of today's webinar will be sent out to participants as well as the deck. And thank you again for joining us.
We will respond to any questions we already have that we didn't get to as well. So that's, we have to send an email to some of these people.
Perfect. And we will do that. Thanks, everybody.
Thank you. Bye.